Thank you to the Flywheel and Ascential team for inviting me to participate in this year's Digital Commerce Accelerator event. I'm Russ, Dieringer, founder and CEO of Stratably, a research advisory and investment firm focused on digital commerce. For today's presentation, I'm going to cover a really important topic in the Amazon ecosystem, which is around aggregators. You've likely seen a lot of headlines about aggregators, which are these firms that have raised billions of dollars to buy up marketplace sellers on Amazon, refine their operations, and accelerate their growth. So I'm going to leave you with a really good understanding of the space, who the main players are, and what the broader implications are for the consumer brand industry. For those of you unfamiliar with Stratably, I founded the subscription research company to help retail professionals better understand what's changing in digital commerce. My research covers a range of topics that matter most to VPs of e-commerce, everything from analyzing Amazon, Walmart, retail media networks, social commerce, and even how teams and organizations are evolving to take advantage of digital commerce. And it's designed to keep you on the leading edge of what's changing today, while also helping you identify what's coming next so you can help guide your organization to success. In other words, it's a service designed to really help you stay relevant in digital commerce. So if you're interested in learning more, check out stratably.com and sign up. Okay, so I'm going to cover a few things in the presentation. First, what are the underlying drivers impacting capital market interest in e-commerce, and how did that lead to the aggregators? Then, who are these aggregators? I'll also talk about the bull and bear cases for this space and end with some implications. So the goal of the presentation is to give you a really solid understanding of the space and come away with an idea or two about how to leverage or defend against this aggregator trend. Now, I know you pretty much can't watch a presentation on e-commerce without talking in some way about COVID. And I didn't want to include this slide because everyone's talking about COVID, but it's just so relevant to what's driving a number of factors that relate to aggregators. Clearly, COVID-19 drove this massive surge in digital commerce. Amazon reached $545 billion in gross merchandise sales last year. That translates to $172 billion in incremental dollar growth alone. You gotta let that number sink in a little bit because that growth is the size of 2.25 Targets. Just incredible. And it wasn't just Amazon, of course. The broader market saw a big step up in digital penetration. And while the total US market digital penetration has come back down a bit based on the US Census figures, for most of the big box retailers out there, digital penetration has remained steady. And essentially every one of these retailers is investing behind and anticipating growing digital penetration from here. And so investors, including public market investors, private equity, venture capital, growth equity investors are looking at this and saying, how can we participate in the growth and dominance of Amazon and e-commerce more broadly in unique and novel ways? And so this shows up in a variety of formats. You've seen a healthy IPO market this year for e-commerce. Retailers and brands, venture capital has pumped billions into e-commerce related startups. And then you see companies tied to Amazon's marketplace going public, with Packable, better known as PharmaPacks, going public via a special purpose acquisition vehicle. Now, who is an aggregator? What do we mean by that term? Aggregators are essentially companies that have raised outside capital, both equity and debt, to acquire Amazon third-party marketplace sellers that were, at least in the beginning, typically small to medium size and often using FBA. These sellers' catalogs were often small, but they had carved out a really good niche on the marketplace, and they were being run by a limited number of people with a limited amount of capital. And so aggregators saw this market of marketplace sellers, if you will, and believed that there was a real roll-up opportunity to buy the most valuable 3P sellers at a reasonable price, remove any personnel and capital constraints limiting the business, and bring a new level of sophistication to their operations and ultimately increase the multiple for a future sale. I show here the backgrounds of 16 different aggregator CEOs to give you an idea of where they came from. And you can see there's sort of three buckets for aggregators. They tend to come from the investor world, investing in a range of different asset classes, from commodities to public market stocks to venture investments. And then you have CEOs that have more of an e-commerce background, including Wayfair, Walmart, Zulily, Nike, and Amazon. And then you have CEOs very familiar with building startups. And so we tend to group all of these companies as sort of one type of aggregator, as if they're all sort of the same thing. But the leaders have different experiences, different strengths and weaknesses, and are going to approach the variety of challenges in this market in their own and unique way. Aggregators range in size. Thrasio is the largest of them, followed by Berlin Brands, Perch, Razor Group, and so on. And you can see a large number of significantly smaller aggregators. And interestingly, my personal experience has been one in which there's a wide range of capital being put to work. Just this past month in September, I had a friend that has deep Amazon experience, working at a variety of consumer brands, running their Amazon business, reach out unprompted to get my thoughts on his ability to take a relatively small amount of capital and put it to work buying a couple of small sellers. I also had one of the largest growth investors in the world also reach out unprompted to discuss the opportunity in this space as well. So I'm just seeing this play out in a lot of different ways, and everyone just seems to see an opportunity to make money in the roll-up space. Now, like I mentioned, aggregators originally got started targeting smaller sellers with a relatively small catalog, but a strong niche on Amazon's marketplace. And that focus remains in the market, no doubt about it. Marketplace seller auction sites like Empire Flippers have seen tremendous volume growth and multiple expansion as a result. But because so much capital has come into the market, you're starting to see the larger aggregators move up market, doing bigger deals in order to put more capital to work. For example, Perch acquired Web Deals Direct back in July, and then you may have also seen a couple of weeks ago, Thrasio put $90 million to work on 3 deals in 1 week. So what started as smaller sellers is really now all sellers, including quite big ones. And so this is essentially what's happened to the aggregator market. It started out with capital market investors say, wow, there's a ton of unsophisticated, fragmented 3P sellers that are on the biggest marketplace in the world. They're seeing tremendous growth, and it's a way to tap into Amazon. But as more capital started to come in, the aggregators had to adjust their value proposition, with many citing they had better deal flow. And this, of course, is very common in the broader private equity space. When I worked in private equity, every PE fund manager that came through our doors would talk about its ability to source off-market deals. And that was true for some of them, but not most. But even this deal flow advantage sort of got competed away, and the aggregators had to start selling that they were friendlier to the seller, whether that was with better terms or even sort of positioning themselves as great stewards of brands and products these sellers created, which of course is largely ridiculous because they can't afford to make uneconomic decisions around a brand or product that they acquire. But at this point, we're now even in an environment where they're competing based on who can get a firm offer put in front of the seller the fastest. And so when you think about this evolution in the market, it suggests that the market is in fact very, very competitive, and the nature of what it will take to win is changing. Now, finding deals is one thing, but you have to actually run these businesses post-acquisition. So you're seeing this massive hiring spree by the aggregators trying to fill a wide variety of roles. And I was talking to a really well-known executive recruiter in e-commerce, and he was saying that these aggregators are really soaking up a lot of talent. If you're trying to hire Amazon expertise right now, it's rough without these new types of actors in the market, but it's really tough as a result of them. They're willing to pay up with a big part of their compensation offer in bonuses and equity. Now, the other interesting angle here is to apply this team size and hiring data to a consumer brand team. So aggregators are essentially having 1 employee for every $2.5 million in revenue they do, as shown on the bottom right. So if you're having a hard time, convincing senior leadership to add to their Amazon team, you can use this as a benchmark to justify that investment. So we have these different puts and takes, right? These really big, powerful aggregators have a good idea, but a bunch of them enter the market and they're having to pay up to get sellers. And they, at least at first, didn't have a lot of actual Amazon talent, but now they're hiring for that. So some people are bullish on their staying power and others are bearish. I'm going to talk about some of the arguments on both sides. So let's talk about the bull case first. The biggest thing going for aggregators is that the market is massive. And even with 9.6 billion, there's a big market out there with an estimated 1.5 million active sellers. So although there's been a lot of capital raised, we're mostly we tend to react to that because it's new. But in reality, the market's quite large, 1.5 million sellers, 350 billion in 3P GMV last year, with strong growth expected in the year ahead. But what about the bear case in terms of the size of the market? Well, these T-Search, which you would have seen if you went to the Prosper Show in Las Vegas last month, pretty much sum it up. The Prosper Show is essentially the biggest trade show for Amazon 3P sellers, and there were these people walking around indicating that they'd buy you a Tesla if you referred a seller to them, and they ultimately acquired it. Just as a rule of thumb, if you're ever in a market and investing in a space and you see things like this, it's very crowded, then you know it's going to be really hard to find off-market deals, and you're facing a lot of competitors. And so it's much more difficult for aggregators to find proprietary deals nowadays, and you're seeing multiples increase because the sellers have become aware of just how in demand their businesses are. And so when I talk to those in the industry, they describe it as a tough environment to source deals. And so that's meaning some are starting to change who they're pursuing. It's not now the FBA seller they want, but maybe a D2C native brand that they can drive growth by bringing onto the Amazon marketplace. Now, I did a little back of the envelope calculation, and you can see that at $350 billion in global 3P GMV by Amazon and 1.5 million active sellers, after you do some adjusting for the 80-20 rule, I estimate that around 3 to 12% of the total market of sellers would have to change hands to put all the capital to work that's been raised today, which is difficult. And so you're getting, these types of t-shirts. So who's right? Are the bulls right? Are the bears right? Multiples have gone up. Aggregators are saying deals are very hard to find. It's very competitive. But of course, we can't forget the exit opportunity for these aggregators. Many of them are trying to arbitrage the multiples in the seller marketplace that, while yes, they've doubled or even tripled, they're still a fraction of what capital markets are valuing the aggregators at. So Bain took a stake in Berlin Brands Group recently, and Packable, which is sort of a useful for comparison's sake, are trading at 3.5 to 3.7 times revenue. That's a major gap that these aggregators have in mind when they raise money. Oh, by the way, if any of them can truly pull off turning these into what they've described as a modern day CPG brand, then the upside is even higher. Now, no one really knows what a modern CPG brand means necessarily. I think some just equate that a bit naively to 100% sales online or something, but I thought maybe a more accurate comparison is Warby Parker or Allbirds. Warby is trading at 15.4 times revenue in the public market. So this multiple arbitrage is why you're seeing more and more capital come into the market, and why you'll see even more come in over the next year, and why despite multiples increasing for sellers, there's still a big arbitrage play. The second thing going for aggregators is that there are plenty of levers to pull on Amazon, particularly with unsophisticated sellers. So this is an example of how Thrasio goes about driving incremental growth for brands it acquires. You can see it expanded to international markets. It invested behind enhanced customer service that generates responses in less than 12 hours. It shortened the feedback loop between consumer review data and its brand teams to help with things like updating PDPs or even product development. It also increased paid search investment, and then it invested more into marketing tests like affiliate marketing, generating external traffic to pages, etc. So I think this is a good general case study in the types of levers these aggregators have at their disposal. And then on the cost side, you also have the potential to wring out savings. All of these sellers have their own back-end accounting systems, inventory management systems, they all have sourcing operations, and these business operational elements can be consolidated across a portfolio of sellers. So that's part of the case. Now, bears would say that the sellers they're buying aren't that unsophisticated. If you take a seller doing 5 million in sales on Amazon, that's actually pretty big in terms of needing to know what you're doing on the platform. So you're not going to get to that amount simply by finding undertapped keywords. So, this seller account was someone or a small team's livelihood. They were 100% exposed to Amazon, so they likely learned every little tactic they could. They were also likely spending on the most needle-moving areas like paid search, and they had the benefit of being able to use sophisticated tools at reasonable prices. In other words, the levers I spoke to before have already been pulled to some degree. Now, maybe capital constraints were limiting the seller, but even there, Amazon and other financing companies have come out with different financing options for sellers to grow their business. And in addition, as acquisition sizes have gotten larger, big sellers doing 50 million, 100 million in business are simply pretty sophisticated already. So bears would just say, look, the sellers have access to a lot of tools already. They're super focused on it because it's their whole livelihood. And these aggregators are going to struggle to identify, multi-year, really needle-moving levers to pull. Now, who's right? On this one, in some respects, it doesn't really matter because aggregators are going to be a real threat even they're going to be a real threat if they're in your category. So even if they don't have a ton of levers to pull or outside marketplaces to expand to, the one thing that they can do relatively easily is funnel more money into advertising jacking up the CPCs, making it more expensive to keep your products visible. While the existing seller may have been sophisticated, they did not have as much capital, and they also didn't have as much of a need for growth that the aggregators have. In addition, if they're in your category with one acquisition, it means that their category is going to be a focus. So all of those little ankle biters that you were competing with, they have the potential to get gobbled up by an aggregator, which suddenly can become a much more meaningful competitor. So the takeaway here is that, if you're spending 6-7% of sales on paid search, maybe that ends up going up a few points to stay even on visibility. So it's a more competitive environment. The third driver behind the bull argument is the potential expansion to other marketplaces and channels. Amazon is certainly not the only marketplace available to sell goods on. Many aggregators point to opportunities to get additional points of growth on marketplaces like Walmart or even smaller ones like eBay. And of course, there are international marketplaces like Alibaba, which would be huge if a seller wasn't there already and the product made sense for it. So, this argument makes sense if the sellers being acquired are mostly FBA and 100% focused on Amazon. The other sort of obvious expansion opportunity is to move into brick and mortar stores. As the chart illustrates, 80-85% of sales are still happening in physical stores. So there's this big opportunity for aggregators to take these digitally native brands and get store distribution. And this concept of going to stores is already occurring in a much larger way in D2C channels. Several D2C brands have formed relationships with Walmart, Target, Whole Foods, and so on, leveraging the proven demand for their products into a compelling pitch to these merchants. Now, Amazon native products crossing into stores is much rarer at this point. Anchor making its way into Best Buy is probably the best known example, but I think that was mostly because it was a highly fragmented seller environment. It was next to impossible for a small seller to get in front of a Walmart merchant, but it certainly will be much easier if Thrasio, if it has 25,000 ASINs and it's doing business on Walmart's marketplace, to get a meeting set up and talk about its most promising products. Now, interestingly, you don't hear this type of approach coming from the aggregators themselves. Chris Bell at Perch mentioned they had some talks with brick and mortar buyers, almost in passing in an interview, but you don't really hear them talking much about this. And, I don't really understand why. You've got 85% of retail sales happening in stores depending on the category. This is such a natural growth engine. You see D2C brands making this jump already. Perhaps it's because it's like sort of, normal retail, in some respects, and maybe aggregator investors want to believe a different story. But to me, this just seems like a major growth driver and should really raise, I think, the heads of incumbent brands that have seen aggregators enter their space. And it's also why everyone inside consumer brand organizations, not just the digital teams, need to be paying attention to what's happening in this space, because it's going to ultimately impact the full business, not just the Amazon business. Now, the bears would say in response to the opportunity for expansion that while Amazon's marketplace isn't the only marketplace that matters, it essentially is. There just isn't that much incremental traffic to Walmart or eBay's marketplaces, and even a majority of Walmart members indicate Amazon's their preferred online site. And when aggregators point to marketplaces like Newegg, it doesn't make sense. So they just aren't that material to future growth, according to the bears. So I like thinking through the bull versus bear case on aggregators. And look, what's probably true is that all 60 plus that have entered are simply not going to make it, but some are. And the ones that will succeed will be the ones that have the right combination of deal sourcing. They'll hone in on the right type of seller they're looking for, and they're put in place of people, processes, and technology to drive continued growth that meets their investors' expectations. Okay, so that was a fast 25 minutes on aggregators. This very interesting, sort of far-reaching development in the Amazon ecosystem. And while all of us can have an opinion on the longevity of these new entrants, I think this should really matter to consumer brand CEOs. First, aggregators are capital markets validating a digital narrative. These aggregators have raised billions of dollars by crafting an image of what a modern day CPG brand could be. But to me, that means existing consumer brands have that same opportunity. Tell the street your digital narrative. What does your company look like 3 years from now with digital at the center? That's going to be the key to maximizing firm value. Second, don't underestimate the aggregators or the third-party sellers in your part of the market. There's is much greater likelihood they can make the leap into physical stores when they're backed by an aggregator, in addition to creating a more competitive environment online. So take action. If you're the CEO, put your own corporate development team on it and see what type of strategic acquisitions are available to your business. And finally, gain more conviction in building out the e-commerce enterprise. These aggregators simply don't have that legacy baggage, and they aren't constantly fighting over where that next incremental dollar for personnel or advertising or capability is going to go. It's just going to go to where they can drive the most digital growth. And so listen to your VPs of e-commerce, listen to your Amazon national account managers, and give them the benefit of the doubt on those 50-50 calls. Okay, that's it. If you'd like to talk more with me about this topic, please do reach out. And if you've enjoyed the discussion, check out stratably.com, as I think you'll really like the work that I publish each week. So thank you again to the Flywheel and Ascential teams, and hope you all really enjoy the rest of the Digital Commerce Accelerator event. Take care, everyone.